All right, friends. So you have financial planning questions? I hope I have some answers. I hope I do. So we're going to go over a Q&A. Every now and again, I'll get, well, not every now. I get a bunch of questions on my Quora kind of blog. So Quora.com, you can look up Josh Scanlon, Sandlen, and you'll see my blog there. And I post some stuff on there, but generally speaking, I just answer a lot of questions that come to me. It's a pretty good place actually for this kind of stuff. Quora.com, Quora. And I figured I'd just share some of the questions I have that I've received yesterday and today, and we'll just answer them. I think it might be interesting, and we'll see if you get anything out of that. So, as always, if you like what you see here, subscribe. I think it's on that side when I'm live. Hit the subscribe button down below. I hit the subscribe button and then hit the bell to be notified for future content. I think if you have a question, you can ask on here as well. I see a little thing on my right side. It says top chat. So if you have a question you want me to address, by all means, fire away as well. So this is the first one I have, and I like this one a lot. How should I decide whether a risky investment, large upside and downside, should be made in a Roth account or a taxable account? That's a great question, actually, and that's Alexander had written that in. And the easy way to answer this is you look at it. This is what I do all the time, folks. You have three different kind of buckets. Now I'll show you here in just a second. All right, so you got these three buckets. You got tax deferred, tax free, and taxable. And I know that writing is pretty poor, but I just did it off the fly. In this bucket, your tax deferred bucket, you want all of your accounts that pay interest in particular. So bonds. Now, I'm not a big bond guy, but if you have bonds, you want them right here. Okay, that's where you want them. The reason for that is because anything that you have in this account won't pay tax yet, but it will pay tax in the future, and it's going to come out as ordinary income. And so basically, this is where we want all of our CDs, our bonds, government bonds. Anything that pays a lot of interest, we want here. All right, now these two accounts is really where Alexander's asked the question, which should go on here. All right, so on your tax-free account, now that's going to be your Roth IRAs. Some people throw life insurance in there. I'm not going to do that here. Your Roth IRA is your tax-free account. And in there, you should have anything that has high growth potential, but also pays a dividend or capital gains. So if you kind of think about it like this, I don't want any bonds in my Roth IRA, all right, because that you just don't. You don't want any bonds in your Roth IRA. And the reason for that is because I get the ability to get my account to grow tax-free without the government jumping on and weighing me down with a lien. And that's what this account right here has. They have these liens on your property called taxes. And if we can get tax-free growth at all, without any growth whatsoever, we want that to be collected from us. We're paying the tax today, get the tax-free growth in the future. So we want the growth in that without question. So if we had a dividend-paying account that pays capital gains like a mutual fund, we'd want that to be in the tax-free account as well, because the dividends and capital gains will be tax-free. It's tax-free. All right, so we in the traditional IRA, 401k, 403b, TSP, I guess, and then 457, we want anything that pays interest income. Interest income should be in this bucket. Capital gain and dividend interest should be in this bucket. That's the Roth. TF is Roth. TD against tax deferred. This bucket is your taxable bucket, your non-qualified account, a tax account, tax account. In that bucket, we want anything that's super duper aggressive that doesn't pay any dividends, doesn't pay any capital gains whatsoever. And there's a reason for that. A couple reasons, actually. The more aggressive in this account, obviously the more upside, that's a fact, but the more downside as well. And the more downside means that if the account does drop in value, you can sell it for a loss, and you can take that loss against future gains and even against $3,000 of income. That doesn't get used very often. It should be, actually. So let me give you an example. In this account and this account, here, the tax-free account, you have your S&P 500 index. We'll use the Vanguard VFINX. Yeah, VFINX is the S&P 500 index. It does pay some dividends, and on an index fund, it's not going to have much what's called turnover, i.e. capital gains, but there will be some. All right, so that's going to pay dividends. That's going to have a little bit of capital gains of turnover, and that's going to cause taxes if it were on this side. But because it's in a tax-free account, the capital gains and the dividends are tax-free as well. So it can just grow and grow and grow because you already paid the tax on that. Now, in this account, on the other hand, we want the extended market index, to give an example. So between the two, S&P 500, extended market index. I'm not sure of the extended market index of Vanguard off the top of my head, but USAA is USMIX. Extended market index is more small company stocks. All right. So you got basically the S&P 500 is the top 500 stocks in the market capitalization of the United States. The rest of the total stock market index is the extended market index with the Wilshire 4,500. So you combine these two and you have the total stock index, which is the Vanguard's BTSMX. This is 500. This is 4,500. These are the largest blue chips. And other than GE, which is just getting hammered lately, most of these guys you're familiar with and they pay a dividend and you're pretty comfortable with. Now, some of those guys can lose. Now, don't get me wrong, but obviously that's your blue chip stocks. Here, you got all the stocks we don't even know about. You got the smaller companies. You got some that are going to go kaput and some are going to become the next Amazon. So here is your more aggressive ones. They don't pay typically a dividend. Now, you're probably going to have some, community banks. You might have a community bank in Duluth, Georgia in here that, again, if it's an index fund, you don't know. And it might pay a little bit of dividend, but it's going to be minimal because you got 4,500 stocks in here. So you're spreading your assets among many different stocks, which means not one stock is going to give you a lot of income. And not one stock is going to make or break you when the markets go down or go up. It's just not going to happen because you're spreading your asset class among 4,500 different holdings. And so what happens here, the more that sucker can grow, all right, if you're not paying dividends or capital gains, and you're going to pay a little bit, but it won't be much because you have 4,500 different constituents in this. Now, when you die, that transfers tax-free. The growth that you have in this account transfers tax-free, because of what's called a step up in basis rule. The step up in basis means if you started with 100,000 in here and it grew to 500,000, that $400,000 of growth that you had transfers to your heirs completely tax-free. Step up in basis. Say you started with 100,000 in the Roth IRA, it transfers tax-free. Now the Roth does not have a step up in basis because it doesn't need one. It's all tax-free anyway. So here you're taking advantage of tax-free growth in an aggressive account with the underside that if the markets fall, you can sell it for a loss and write off your taxes against future capital gains and against even ordinary income. Here you're just taking advantage of the Roth to give you all the upside potential in the world that you can have. Here, well, that's all taxable as ordinary income anyway. So we don't want stuff in here. This is your IRA 401k. We don't want to convert capital gain and qualified dividends, which are taxed at 0 or 15%, depending on your tax bracket, into ordinary income. We don't want that. So we want anything in here that's going to be taxed as ordinary income anyway. And if this grows to 500,000, guess what? Uncle Sam and whatever state you live get their share of that as well. So again, the question was, how should I decide whether a risk investment, large upside, large downside should be made inside the Roth or the taxable account? And if I was a investing person advising you to do this, I'd say you have a total stock market index. You take the VFINX, you put it in your Roth because of dividends and the small capital gains and the small, what's called turnover. And the Vanguard is about 5% a year. It ain't much. And then you take in your taxable account, you take the extend market index, or any of you have an individual stock. I was talking to a guy on Monday or Tuesday, I can't remember. He's looking at some of these marijuana stocks. Well, they're all penny stocks, so the likelihood of any of them hitting the home run is nil. But if it were to, you'd want that in this account here to take advantage of the step-up base rule, and there's no income off it anyway because these marijuana stocks do not have dividends, and they're just because they don't have any cash. So that would be my answer to that. Hope that makes sense there. All right, number 2. If you are starting a new job, are there any reasons you would not roll over your old employer's 401k to a new one? Yeah. There are any reasons you wouldn't roll over to a new one. The answer to that is you don't want the 401k to sit there on its own. So you don't want a bunch of 401ks. I got, company A. I used to work at Smith Barney. I have a 401k there. I used to work at USA, I got a 401k there. You don't want that. And the couple reasons for that is you just can't, it's not efficient. You can't keep track of all this stuff. And secondly, don't forget when you hit 70.5, you have to take mandatory distributions of each account. You can't aggregate them into one like you can IRAs. So you have to take it from A, you have to take it from B, you have to take it from C. And if you forget to take it from C, IRS will be quite happy. They'll charge you a 50% penalty on the amount you forgot to take out. So that's one reason that you definitely want to consolidate your 401ks. Now, should you consolidate it to an IRA or back into your new firm's 401k? And that's where I'm really going to answer this question. The answer is you absolutely should consolidate it to your new firm's 401k. And I can hear some of the investment advisors grumbling, no, don't do that. The 401k has limited options. No, it doesn't. It doesn't have limited options. 401ks are institutional shares, which means the fees are a whole lot smaller than they are for individual shares. I mean, just look at, you can go to Vanguard, you could look at USAA, you can look at any firm. Institutional shares are cheaper than individual share classes, bar none. So anyway, you're going to get less fees on your 401k investments. And on top of that, when I hear, oh, they don't have enough options, under the new rules of ERISA, so you have ERISA 1974, the Employee Retirement Income Security Act, ERISA. Everything has since changed since 1974. So now we have new rules and regulations that any 401k provider is going to be in a world of hurt if he or she is not offering you a wide range of options for investments at a relatively low cost. I mean, there might be some firms out there, but they're soon going to change if they're not going to get sued. They'll be changing so shortly because they just can't take that liability. So every plan out there, and again, I'm saying every infancy, you might be able to show me one off. The vast majority of plans are going to have what you need. Like the TSP, the Thrift Savings Plan with the federal government. They have everything you need. You have an I fund for international. They got the S fund for small cap. They got the C fund for S&P 500. They got the G fund for government bonds. They got the F fund for fixed income, and you're fine. You're fine. The cheapest can be, you're covered. You don't need to do anything else. On top of that, your 401k allows you to borrow against it. An IRA does not. Oh, you should never borrow from your 401k, Josh, ever. That's just wrong. And look, get my book, man. Get my book. I lay it out all in chapter. Let's see, what chapter is this? And page 35, chapter 6. I lay it all out there. You should borrow from your 401k if you're going to pay down debt. There's no debate about that. So let me just give you an example. You got $10,000 of credit card debt that costs 10% a year. You borrow $10,000 from your 401k. You pay that sucker off. What's the interest of your 401k? 5%. Who gets the interest? You do. You do. So instead of paying, stupid bank 10% on $10,000, which is $1,000 a year, you're paying yourself 5% on $10,000, which is $500 a year. All right. So that's $1,500 swing there. On top of that, the money that you're putting in, because you're paying it back, the money that you're putting in still has opportunity to grow. Now, if the markets boom up like they did in 2017, yeah, you're stinking because you only got 5%. The market was up, 37% or something like that? Well, that stinks. On the other hand, if the markets drop, you're loving life because you got 5% paid to yourself when the markets fell 20%. So if you have credit card debt, borrow against your 401k to pay that sucker off. Now, someone put a comment on the thing. I agree with this 100% the other day. It said, the problem with that approach is a lot of people are still going to not get their finances situated. They're still going to borrow against they're still going to get their credit cards high. I completely agree with that. If you cannot control your balance sheet in terms of your spending, well, we have another issue to contend with. But that doesn't take away from the 401k. So you definitely want to do that. Now, people say, but if you borrow against your 401k, you're paying it back with after-tax income because the money that you pay back to the 401k, you don't get a deferral on it. The money that comes out of a 401k as a loan is tax-free too. I never understood that argument. Like, oh, I borrowed $10,000. You don't pay tax on that. You don't get a 1099, nothing. It's just a loan. Literally, it's a loan. So I borrow $10,000, pay off a credit card. I no longer have that $10,000 debt over here. On top of that, I no longer have to pay them a monthly fee. What's that? 1%? I don't even know what that is. $100 a month, whatever. And there's no taxes whatsoever. So now I got to pay myself back. It's after tax money. And somehow, again, I'm worse for the wear. Yes, I'll have to take taxable distributions to my 401k when I decide to take it out at 59.5 or 7.5, but I didn't pay tax on the money when I took it out at 48. It's just weird. So anyway, the drawback finally about 401ks relative to an IRA, and this is actually pretty big. And this is the one area I think financial advisors, if they were smart, they focus more on. On a 401k, it can be very, not very liberal, I should say, very strict, not conservative in the political sense, but very strict on your heirs' ability to have access to your cash or your heirs' ability to act on your behalf if you're incapacitated. Give you an example. I'm driving down the street. I get in a car crash. I'm laid up at the hospital. And guess what? I don't know who I am. All right. So my wife comes in there, Charlotte does, says, hey, the doc says, look, he's going to survive, but he doesn't know who he is. And here's a big fat bill for $25,000. My wife has no cash because she doesn't work. She goes, we don't have any, savings account. She goes, what do I do? She calls a 401k provider, says, I need to get a distribution. My husband's laid up in the hospital. I got to get the money out to pay for the bills. What do they say? Do you have a durable power of attorney? And she's going to say no. Or she'll even say, yes, I do. And they're going to say, that's great. Fax it to us. And they're going to say, no, we won't take it. We needed something by the judge or by the county clerk or whatever it would be. We need something in writing by a court to prove that you are have the durable power of attorney. The 401k provider can be very, very, very strict when it comes to acting on the behalf of their owner. And that would be me. I'm in the hospital. My wife is my heir. Not my heir is death, but my power of attorney, my agent of fact. The 401k can be very, very strict on that. Now, if I die, the 401k can be strict as well on my wife's ability and certainly my kids to take the money out. They might force the lump sum distribution. They might force 5 years, got exhausted within 5 years. They might not allow my heirs to roll the 401k over to their own IRA in order to stretch out the distributions over their own life expectancy. So 401ks can be a little bit more, what's the word I'm looking for? Just strict, I guess is, I don't know how else to say it, than a IRA. An IRA, on the other hand, a USAA, we had this off the shelf, durable power of attorney. You pull it off the shelf, filled it out, took it to the bank, get notarized, and there you go. Now my wife has full unencumbered access to my money when I'm incapacitated. And a durable power of attorney means it survives incapacity. So that means it's available now too, even if I'm not incapacitated. So she could literally, meet up with the weightlifter guy down the gym there and say, I'm taking all Josh's money and take it out. That's what durable power of attorney allows you to do. So there's obviously some risk inherent there. But it survives incapacity too, which means when I'm laid up, she just calls my IRA provider, in this case, USAA, says, hey, this is Charlotte. My husband's in the hospital. I need $25,000. And they're going to say, yep, okay, Miss Charlotte, here's your $25,000. They're going to validate a little bit more than that. And that's what can happen. So a durable power of attorney means it's effective now while I'm, theoretically in good shape. And then it survives incapacity. So it will it's still ineffective when I'm in the hospital. A springing power of attorney, just as an FYI, is different. A springing power of attorney only comes into effect. It springs into effect when you are incapacitated. And that we got to validate that you are incapacitated. And you have to do that by going to a doc, maybe two, and having them sign off that you are incapacitated, or your spouse would have to. They don't want that. So a durable power of attorney is what you want, unless you are worried that, again, your spouse is going to run off your assets, or if you make your son the agent of fact that he's going to sniff it up his nose or something like that. You don't want that. All right. So that's a durable power of attorney. A general power of attorney, just on a side note, it stops at incapacity. So you have durable, which is both incapacity and capacitated. You have a springing, which doesn't go until you are incapacitated, but then it springs into effect at incapacity. And then you got a general, which stops when you're incapacitated. My preference would be to have a durable power of attorney. And an IRA is much, much more favorable to your ability to act on that behalf than a non-IRA, a 401k would be. All right, this is a good one. How are financial planners usually paid? This is a great one because actually I'm working right. Well, not working. I was laid up in the hospital, not dead. Just going back to the durable power of attorney thing we just talked about. What do you think, YouTube land, a financial planner does? And I would bet if we took 100 YouTubers off and just grabbed it by random, the vast majority would say a financial planner manages investments. And that's a bad thing. So I'm looking back at this lady with my colleague, with her clients that she just inherited because they needed financial planning. And the husband had a stroke and he didn't know, or a heart attack, something like that. He doesn't know who he is. Just think about all the previous financial planners that they did not hire or did not use, or the financial planners were negligent in doing financial planning because of the idea that financial planners are there solely for investment management. In fact, if anything, I wish financial planning as a whole, and it's going to happen, did not charge for investment management. I think that's the only way for financial planning to be its own legitimate industry, is to say, if you want investment management for a fee, there's an investment advisor over there you can pay for. between you and me, I challenge the need to do that. But you could do that if you wanted. Now, that's fine. But that's separate from actual financial planning. Financial planning is so much more engaging, so much more beneficial than just whether or not I can manage your money. I mean, you can do this so much more engaging, so much more beneficial than just whether or not I can manage your money. I mean, you can do that on your own. Just go to Vanguard. You're good to go. I mean, a financial planner can guide you to that, but a real financial planner, in my opinion, should not charge for assets to manage your money. It's just not good. But that's what they do. So financial planners they'll charge you 1% a year in assets, or 1.5, which is absurd to me, or 0.5. I don't know that many people that do that. So the vast majority of financial planners, unfortunately, will charge you 1% a year. You got $100,000, they charge you $1,000 right out of the gate. Now, that does not mean that's the end of that you pay. You still have to pay for trades. You still have to pay the expenses on the funds that they put you in. That's just a fee that they collect. All right. And so if you have some firms like my previous one, which I've already named, I'll go nameless now, they can charge you upward of 1.85 simply because they charge you their management fee, plus they'll charge you the expense ratios of the mutual funds. I mean, that's insane. And unfortunately, that's not financial planning, and that's the problem. Now, the old days of financial planning is, which really is not that old, frankly, is literally this is what investment advisors were doing. They charge a commission. I haven't any problem with that. I just did a video, I think, yesterday on commissions versus fees. Paying a commission is fine, but that's not financial planning, man. That's investment advice. So a financial planner like me should charge you, and this is my fantasy, that you go hire a financial planner for financial planning. Crazy that would be. Hire a financial planner to do financial planning, which means you pay me a fee, and my fees are on my website. You pay me $1,500 for a full-fledged financial plan for 6 months, and then we can revisit $750 a quarter. If you just have a one-time thing, I got a couple of ladies coming in on Monday. It's $500 just to review everything. I tell them what they should do and move on their way. That's simple. Now, I will tell them how to invest. Don't get me wrong. I'm going to tell them this is what you should do. But I don't charge for investments, and I wish more financial planners did not, because the vast majority of people don't have the cash to invest with a financial planner, but the vast majority of people still need financial planning services from a professional. What is a good age to raise a contribution percentage of your 401k? It's a pretty good one. It's a quick one. And that's it. That's way too broad of a question to answer. But at the end of the day, my friends, you should take advantage of your firm's 401k up until the match, and then don't do it. All right. And the reason for that is going to be contingent really on your taxes and who you are. But you should take advantage of your 401k up until the match of your firm, and then don't do it. And now you should do that into the Roth part of the 401k. So I'm right there. I'm assuming there isn't a Roth 401k option available to you. If there is a Roth 401k, you should put every single penny that you have into that you can squeeze out. Like Jesus says, you should give till it hurts. And that same thing with a Roth 401k. You should put every single penny you have into your Roth 401k until you can kind of feel the fire under your butt saying, "Ooh, it's creeping up on me." That's a good place to be. And the reason for that is because the Roth is so beneficial. In my second book I just published, I'm almost done talking about it on my YouTube channel, talks all about the benefits of a Roth, the tax bomb in your retirement accounts, and how the Roth can help you avoid it. Absolutely should do that. What is that exact percentage? I don't know. I don't know until I know your cash flow. Now, I don't want you to do anything that's going to add to your debt level. I'm telling you right now, debt is the biggest issue. So don't put 10% in your Roth IRA or Roth 401k at the expense that now you're adding 5% a year to your debt. No. That's not what we're talking about. I want you to put it in there until it hurts, but not until it hurts where your debt level is growing. Wrong. Who is liable for the taxes of a deceased individual if the estate doesn't have the funds? I thought that was a pretty interesting question. I almost didn't answer this, but I'm going to. So who is liable for the taxes of an estate if the estate doesn't have the funds? And the reason I want to answer that question is because there's two things going on here. And again, it's hard to get a gauge of if the guy knows the real question he's asking. Hard for me to see an estate having an estate tax if there is no net worth in which it can be liquidated to pay the tax. Because what happens on an IRA or 401k, these are what's called IRD assets, income with recipient or with respect to decedent, IRD, income with respect to decedent. The tax on those accounts, 401ks, 403bs, IRAs, the state doesn't pay. You pay as a recipient, the heir. And so that's not as taxable to the estate. And the state could have a tax, like I just use Massachusetts, like I did in my podcast. In Massachusetts, if your estate is over $1 million at your death, your estate is going to have an estate tax, but that's net worth. All right. So that means your home, subtract by your debt, that will be your net worth. And so in that, you'd have to liquidate the home, and the bank won't release the deed of trust on your home until that puppy's been liquidated. If there's a mortgage, and then you have to pay the bank. And then if the state of Massachusetts, Commonwealth, if you owe them taxes, they're going to want theirs too. So I don't really know the answer to that, because I'm just trying to think of a scenario where you would have to, a state would owe taxes without having any liquidity. A life insurance policy, same thing. The estate would owe the taxes on it, but it's not going to be released until the estate tax is paid. A home, again, net worth. The net worth is simply your assets minus your liability. So yeah, I don't know the answer to that, but hard to see how that would be. So I just want to answer that. Let's see. Can you collect Social Security if you're running an all cash business? Well, the answer is yeah, absolutely. It's a contingent on, do you have the 40 quarters of working that qualify for Social Security? So 40 quarters, that's 10 years. You have to essentially make $6,000 a year for 10 years, or $6,000 in one day each and every calendar year. As long as you make roughly $6,000 in a calendar year, and you do that 10 times, you'll have the 40 quarters, and you can collect Social Security. Now, it's not going to be much because they haven't put much into it. And so this is the funny thing I hear. I want to collect Social Security. Well, have you paid into it? No, but it's not fair. Well, you haven't paid into it because you're running an all cash business. You're not going to collect. If you have only paid into the very minimal, the 10 quarters, because you're running an all cash business, you will get some, but it won't be much. It's based on your record of contributions. And that's how Social Security works. You have a record of contributions, and they're going to base their contributions to you, your benefit, based on your record of contributions. The only way it can work. Now, if you're working at Intel, making big bucks for 35 years, and now you're running an all cash business, you absolutely can get the full benefits of Social Security. No other way around that. Now, should you do that? That's up to you and the IRS. They're going to say, whoa, I see you're taking all these dividends and not giving yourself a salary. The reason why small business people think that's a great thing is because dividends are not subject to FICA. All right, FICA is Social Security Medicare tax. And so people think, oh, if I take a dividend, I don't have to pay the 7.65 on both sides of the equation. So I'm saving myself 15% tax right out of the gate. Well, you are, but you're going to hurt your Social Security benefit in the long run. And I don't think that's going to be beneficial to you. But be it as it may, that's up to you. Now the IRS is fully onto that too, by the way. So trust me, if you're self-employed, they're going to know if you're paying yourself a dividend or if you're paying yourself a salary, because they'll see that you're not paying your FICA taxes. And if you think you're the only person who ever thought that through, you're wrong. Is buy term and invest the rest dead? The answer is it was never alive. Not that buy term and invest the rest is bad on paper, but just no one does it. All right, so here's how buy term and invest the rest goes. I can get a term policy for $50 a month. I can get the same policy as a whole life or a universal life policy for $250 a month. So what I should do is take $50 a month, buy the term policy, and that $200 a month savings, I'll invest it. So I'm buying in term and investing the rest. What always happens is that people have a reason not to invest that $200 a month. They'll invest some of the rest. The kid's got braces, their kid has to go to college, whatever it would be. I want to go to Hawaii, so I'm not going to invest the rest. I'm going to invest part of the rest. That happens all the time. And so because that no one ever absolutely buys term and invest the rest, they might buy term and invest some of the rest. Generally speaking, they'll buy term and not invest anything. And so that idea that is buy term and invest the rest is dead. In reality, it never existed. On paper, it's still not dead. I mean, if you can literally discipline yourself to do it, you absolutely should do that. I've been around for a long time. Very rarely have I seen that play out. What's the most underrated financial planning advice, which is highly effective? The most underrated financial planning advice, I think, is the tax code, frankly. I think if you understood the tax code, you'd realize to follow the herd when it comes to tax deferral is bad. And so what I mean by that, the counter to that is to follow the go on your own, pay a little bit more upfront for your Roth IRAs today, and then the benefit you'll receive in the future is immense, which is, again, my cheap sales pitch for the book, why I wrote this book, because a Roth IRA will give you tax-free income, It won't tax your Social Security. It won't make your Social Security subject to taxation. It won't raise your Medicare premiums. It won't cause qualified dividends and long-term capital gains to be taxed. It won't tax your surviving spouse, which in that case will also not increase her Medicare premiums and all the other things that go with that. And finally, it won't tax your heirs. The Roth IRA is absolutely the way to go. It's almost like the butterfly effect. A little bit of taxes today that you save on a traditional IRA is going to explode in more taxes in the future. And because of the idea of most people being brainwashed and trained not to pay tax today, they miss the ability of the Roth IRA, and I just find it to be horrific. Roth IRA is your friend, my friends, and you should be taking full advantage of it to the extent that you can, without question. And if you don't believe me, just get my book. In fact, if you go on Amazon right now, I put it for free until Monday. You can get this sucker free of charge until Monday. So just go on Amazon, type in that right there. That's my last name, and that sucker is available to you free until Monday for sure. All right. Why do banks give you so much less return they can get with index funds? That's a bad question because mutually, they're not apples to apples. I think what he's saying here is why should I get a CD at a bank and when I can get index fund for a higher rate of return? He asked, why do banks give you so much less, or she so much less they can get with index funds? Well, so inherently a CD will give you less than an index fund, generally speaking, but it certainly didn't from October 2007 to February 2009, well, March 9th of 2009 to be precise. CDs did much better than index funds. Why? Because the index funds fell 54% and your CD was up 3.5% that time. So it completely contingent on who you are, what you need for, what you're trying to accomplish. But banks inherently aren't bad investors, and index funds are good. It's not like that. In fact, you can even buy an index fund at the bank. You probably ought not to, because they're going to charge you a fee and a commission that if you just went directly to the manufacturer, be it Vanguard, they won't charge that. And the last one here is, what was your top learning from the financial crisis of 2008 and 9? And that's easy. You ready for it? Your top learning from financial crisis of 2008 and 9. I wish more people would adhere to this, because I lucked out. It could have been a whole lot more deadly. Just telling my daughter who I just took to Georgia Tech the other day how much we lucked out. It's not to have debt. It's not to have debt. In 2008, 2007, we were starting to hurt my family. The market was starting to crumble. I was getting paid as a percentage of assets under management. And in October 2007, the market started sliding. So in 2007, from October to December, and we got paid on a quarterly basis. So I think it was quarterly, but I can't remember. But anyway, if the market's crumbled in a quarter, your income crumbled in a quarter. Now, I was building up a fee-based investment advisory firm, again, referring to myself as a financial advisor, but really just an investment advisor. I had a CFP. I'd already been in the business for over 10 years. And then I'll never forget. So I remember December of 2007, I was thinking, this ain't going to work. The markets are falling, my fees are falling, and I got 6 mouths to feed on this one income. That's going to be tough. And so I started thinking, this is not going to work. So then we go into 2008, the markets are falling even more, and my income's falling even more. And even worse than that, people are getting out of the markets. Not only were the markets dropping, but the people who were in the market were getting out because they didn't want anything to do with it. They didn't want to lose any money. So I'm losing as a percentage of assets, and then I'm losing because people are less inclined to invest. A bad place to be. Thankfully, one day out of the blue, USAA called me. I don't know. I had a CFP and I'm a veteran. So they called me and they offered me a job, and flew down to San Antonio. And man, I lucked out. I took it in May of 2008. It was the best thing I ever did because they paid for my relocation. They paid me a salary. The problem was when I got down there, I had not learned my lesson. I just learned my lesson on cash flow. And I bought essentially the nicest house we could afford because that's what they always do. And it's my own fault. I don't blame anybody else. You can buy this house or you can buy that house. Well, this house looks better and you can afford it, right? Because your salary says you can afford it. And I said, yeah, let's go ahead and do that. And I wrote about it in this book, my first book. Again, another shameless plug for my first book. I wrote about it here in detail. We put everything down, or what did we? I can't. We didn't have any cash though. All right, and I get to my job at USAA, and there's nothing for the first 3 months. I'm sitting there thinking, why are these guys going to keep me? And I always thought LIFO, last in, first out. So if you're the last in, you're the first to go. There's layoffs galore back then. It was scary as heck. I'll never forget that. Thinking I got this wonderful house in Bernie, Texas, loved it. but we didn't have any cash, and we're making decent money as a salary. But if that salary was yanked from me because USA says you're not bringing any value to the table here, and frankly, they should have, because we weren't. There's literally nothing for me to do for the first 2 to 3 months. I mean, a couple of clients I talked to, but I mean, basically, I'm just sitting there like, what do I do? And that was scary, man, because I had no, I mean, it was literally, it's not people getting laid off all over the place. People in my neighborhood, foreclosures. I mean, you all know this. And so the lesson to be learned, and I still to this day wish I could learn it better, but is if you didn't have debt, you could be a heck of a lot more nimble. You could go to a place where the jobs were. And thankfully, I did have enough equity in my house in Virginia. I was able to sell it so that way we could relocate to Texas. But I know people who had job opportunities on the table for other states, who had good job opportunities, working for the railroad, working for the government, working for, and I'm not saying these are good or bad jobs, don't get me wrong, but when you're a hurting unit and you just got laid off, working for a government is not a bad place to go to get health benefits and to get stable income, or work for a big company, in Seattle or something like that, whatever. But I know for a fact, I know for people that had opportunity to relocate to another state to work for a good union job in this case, where they got benefits, they got salary, but they couldn't sell their house because they're upside down. And so now they're sitting in this crappy old job, hating life, because they know they have this other job. If they can only sell their house, but the market's crashed, they have no equity in their home. And so now they got a $400,000 mortgage, but only $300,000 fair market value, and they got no cash to pay for it. I've seen it happen a million times a Sunday. I'll never forget. I had this one, my first clients at USA. I remember her because I had literally nothing else to do. Her mom had died. Her mom was a big attorney in South Florida, making big bucks, man, big bucks. And had this whole real estate empire built up that she was getting all these rentals from. And this was back in 2005 and 6. She was building up this real estate empire, and then she died. And frankly, I don't know if she killed herself. I don't know. But the daughter was an executor of the estate and had all these properties, these condos and whatnot that the mom had borrowed to the hilt, 100% loan to value. But now the market fell in South Florida, 40% of value. So a $250,000 house is now what, 150, and so she has $150,000 equity, or not equity, fair market value on a $250,000 loan. And she had it priced all over the place. And, renters are walking out, they're taking out the copper, taking out and that, I don't know if the mom killed herself, but you think back to the Depression, that happened. That's called leverage. That's what leverage can do to you. And leverage is nothing more than debt. And I'll never forget her. I said, there's nothing you can do. I mean, you're not going to take ownership of these condos because, for right now, they're so far underwater. There's nothing you can do. Now, as the executor, in this case, the executrix is a woman who manages the will. An executor is a man who manages the will. A trustee is gender neutral. A trustee is a person who manages a trust. All right. So if someone says an executor, they're talking about a will. When someone says a trustee, they're talking about a trust. Just keep that in the back of your mind. I'll get into more of that in other videos on the difference between a will and a trust. But anyway, I said executor, you're not tired. You just walk away. But she was flummoxed. She's like, her mom was wealthy. Well, she wasn't wealthy. She was leveraged. Not good. I was leveraged. What does leverage means? You have more debt than you can afford from cash flow. Now, thankfully, I had enough cash flow to keep paying my mortgage. That was good. But I'm telling you, those 3 or 4 months there scared the heck out of me. I remember thinking I'm going to get laid off. And then one day I had a client called in, and he was not happy. It wasn't me, but something happened. I forgot. And I forgot what it was. There's just something that happened that went wrong for some reason. I remember he filed a complaint. It wasn't on me. It was on USA. I can't remember the whole thing. It was just the guy was mad. Guys, I forgot what it was, but I just remember thinking, if they put that back on me, if they laid me off? And for like a week's time, I thought I was going to get fired. And no one ever said that, but that's just how worrisome it was. I got nothing other than this house. In this house, I have a little bit of equity, but not much because I use a VA loan. And I had no cash because all my cash was blown away to basically improve my house in Virginia to sell it so we could move to Texas. Scary. It worked out. Thank the good Lord. It worked out for me. But I know many people didn't work out for it. I know that for a fact. So that's my lesson from 2008, 2009. And something I actually hope that our society we can go back to, which is maybe living a little bit less high on the hog here in the States. Maybe, I don't know. I don't know. I'm guilty as anybody else. But I don't know, a little bit of maybe not consume so much. And look, I'm capitalist as all can be, but maybe use that car for a couple extra years. I don't know, whatever it is, but maybe don't throw away things so much. Maybe, I don't know, just maybe not consume as much. And that way you can value the dollar a little bit more. Anyway, so that's my lesson. And I don't know the answer to that, how you consume less. I chuckled. Morningstar, the investment firm, the mutual fund company analysis firm, I got an offer to attend their conference on sustainability in Chicago. And I said, you can't, come on, man. You want all these people to fly from the world into Chicago for a conference of sustainability. I mean, that's the two things are mutually exclusive. You can't fly from Amsterdam to Chicago and say you're going to talk about sustainability. Those things don't go hand in hand, especially when you can do it like this. Why don't you just do a YouTube log or Hangout thing, Google Hangout thing? You don't need to do it in person. I know there's a value to do it in person. Don't get me wrong, but I mean, that's what I'm talking about. If we're talking sustainability and just maybe watch the bottom line a little bit more, not consuming as much, having a sustainability conference in Chicago just seems to be to be a little bit odd to me. And I chuckle a little bit at that because that's not sustainability, my friends. So I hope this was helpful, a little bit rambling. I get it. I can ramble like the best of them. So if you like what you see, subscribe on that side. I think when I go live, subscribe down below. I saw a couple likes, hit the likes. Likes always help me. Absolutely. Likes help me. It tells YouTube algorithms, hey, somebody likes this guy. We don't know why, but somebody does, and they're going to show it to other people. Comments are always helpful. I'm telling you, comments are probably the most important thing you have. And then, of course, subscribe. That's a big deal, too. Blog, heritagewealthplanning.com. You'll see the pop-up that shows up. This book is for free on PDF if you fill out your information on the pop-up. But if you just go to Josh Scanlon on Amazon, Josh Scanlon, you can get this for free until Monday. Doesn't cost you a dime. And I'm trying to get the word out there. And if you know folks who are interested in Roth IRAs or you think they need to be, man, tell them about this because and Amazon likes that too. The more people download on Amazon, the more street cred they give to show it to other people as well. So, hey, we'll see you next time. Thanks, guys.